13% yield from U.S. Treasury bonds sounds like somebody found a cheat code. They did not. The government is not suddenly mailing out giant coupons. This fund takes long-term Treasury exposure, puts it on an options workbench, and trades away part of the upside to manufacture monthly cash. Since launch, those checks have arrived with impressive regularity. The underlying share value, however, has moved in the opposite direction. That tension is the entire autopsy. Is this a productive income machine, or is the payout merely making a difficult bond investment look healthier than it is? Today, Income Autopsy is dissecting the Amplify TLT U.S. Treasury 12% Option Income ETF, ticker TLTP, using data as of July 16, 2026. This is not an ordinary government bond fund. It belongs to the long government category, but the label only describes the patient on the table, not the surgical equipment surrounding it. The fund takes exposure to long-dated U.S. Treasury bonds and adds a systematic option income overlay. In plain English, it starts with an asset whose price can move dramatically when interest rate expectations change, then repeatedly sells other investors the right to participate in some of its near-term gains. That produces a very different experience from simply holding long-term treasuries. The ordinary investor waits for bond income and price movement. This strategy tries to pull additional cash out of that price movement as it happens. When the market is noisy, the option market may pay well for that privilege. When bonds rally hard, the calls can become a ceiling. When bonds fall, the premium provides only a cushion, not a force field. So the real product is not treasuries yielding 13%. It is long-duration interest rate risk repackaged into a monthly income experience. The payout is visible, immediate, and psychologically satisfying. The opportunity cost and capital path require considerably more attention. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value, including funds that invest in government bonds or use options for income. Distribution amounts, tax treatment, portfolio composition, and strategy details can change. Verify the current prospectus, shareholder reports, distribution notices, and other official fund documents, and consult a qualified professional before making financial decisions. Amplify launched the fund on October 29, 2024. It pays monthly, charges an expense ratio of 0.39%, and has $23 million in assets under management. That is a compact operating history and a relatively small asset base. Neither point automatically makes the fund good or bad, but both affect how much confidence we should place in the record. We have seen the machine operate through a meaningful stretch of bond market conditions, but not through every kind of rate cycle. A strategy can look unusually smooth during one environment and very different when inflation expectations, central bank policy, or demand for long-term government debt changes direction. The expense ratio is also only one cost in the experience. It is the stated management charge, not a complete forecast of what an investor keeps. Options can create trading friction, and the economic cost of surrendered upside will not appear as a neat fee on an account statement. If the bond position launches upward while calls are outstanding, the strategy can trail a plain long treasury position even though nobody sends the shareholder a bill labeled missed rally. The asset base matters for practical due diligence as well. Investors should inspect trading volume, bid and ask spreads, and how closely market price tracks underlying portfolio value before using market orders. A treasury strategy may sound institutionally sturdy, but the ETF wrapper still has its own trading characteristics. The headline distribution yield is 13%, and annualizing the latest payment mechanically also produces 13%. The most recent monthly distribution was 23 cents per share. That number tells us the current cash pace relative to the current share value. It does not tell us that the portfolio is earning a guaranteed economic return at the same rate. A distribution rate is a speedometer for outgoing cash, not a laboratory test of where every dollar came from. This distinction is especially important in an option income fund. Cash available for distribution can be influenced by option premiums, portfolio income, realized trading results, and potentially return of capital. Return of capital is not automatically sinister. It is a tax classification and can arise for different reasons. But if a fund repeatedly pays out more than its strategy generates while the asset base shrinks, the investor may be receiving part of the investment back through the distribution window. The current share value also affects the displayed yield. If the payment remains similar while the price falls, the calculated yield rises. That can make a deteriorating capital path look more attractive on a screening website. The yield may be mathematically correct and still be economically incomplete. For someone spending the distributions, the practical question is whether the cash stream and remaining capital can coexist over the intended holding period. For someone reinvesting, the question is whether buying additional shares compensates for the path of the original shares. Either way, the headline is the beginning of the investigation, not the verdict. The first 4 payment average was 24 cents, and the latest 4 average was also 24 cents. Across the paid rows, the distribution trend has been roughly stable. That consistency is genuinely useful information. It suggests the monthly payment has not behaved like a carnival ride during the available history. An investor building a cash flow calendar would probably prefer this pattern to a fund that announces spectacular payments and then abruptly cuts them. But stable distributions are not the same thing as stable earning power. A sponsor can pursue a target and smooth the shareholder experience even while the market value of the underlying exposure changes. The payment series therefore needs a companion chart showing what happened to the capital supporting it. The future path can also diverge from the past. Option premiums respond to market conditions. If expected volatility falls, the market may offer less compensation for selling calls. If long-term bonds surge, the calls may surrender gains that otherwise could have rebuilt capital. If bonds decline, the strategy may continue collecting premiums, while the portfolio itself loses value. The outgoing payment can look calm, while the machinery underneath works much harder. Investors should also verify each distribution's tax character using current official notices rather than assuming every payment is ordinary bond income. A deposit arriving on schedule answers when the cash came. It does not, by itself, answer what the cash economically represented. Net asset value is where the cosmetic lighting comes off. The latest NAV and market price were $20.54, compared with a launch reference price of $25.14. The NAV return since inception was negative 18%, and the maximum drawdown was negative 19%. This is the capital path that the income headline can obscure. Long-term treasury prices are highly sensitive to changes in market interest rates. When investors demand higher yields from newly issued bonds, older long-dated bonds with less attractive terms generally have to fall in price to compete. When expected rates decline, the reverse can happen, and long-duration bonds can rally forcefully. The covered call overlay changes the shape of that journey, but does not remove the rate sensitivity. Premiums can soften some losses, yet they cannot guarantee a floor. Meanwhile, calls can intercept part of a sharp rebound. That combination creates an awkward possibility: meaningful participation in the decline, followed by incomplete participation in the recovery. The drawdown matters because percentages are not emotionally symmetrical. After capital falls, the remaining base has more work to do merely to regain its prior level. A continuing distribution can make the account feel productive during that period, but spending the cash means it is no longer available to help rebuild the position. This does not prove that the strategy is broken. The underlying bond market itself may have been hostile, and an income investor may knowingly prefer cash today over maximum upside later. It does prove that evaluating the fund from the payment history alone would miss a large part of the experience. Cash distributions since launch totaled $4.65 per share. Adding those payments back to the ending share value produces a simple distribution-inclusive return since inception of 0%. That is not an exact reinvested total return calculation, and it should not be presented as one. It is a straightforward economic framing. What happened to the share value, plus the cash that left the fund and reached the shareholder? The result tells a much richer story than either component alone. The investor received substantial cash, but the capital decline absorbed approximately the same economic ground over the measured period. The distribution was real. So was the reduction in the value of the remaining position. Whether that experience was useful depends on the investor's objective. Someone who needed recurring cash may value the timing of the payments even if wealth did not grow. Someone seeking compounding may view the same outcome as a long detour. Someone who reinvested distributions would have a different path from someone who spent them, and taxes could create another difference between reported fund performance and personal results. A fair comparison should therefore include a plain long-duration treasury holding, not just other high-yield ETFs. The question is whether the option overlay improved the outcome the investor actually wanted. Did it reduce volatility enough? Did the cash flow justify surrendered recovery potential? Did the after-tax result beat simply creating withdrawals from a conventional bond position? A large payout is valuable only in relation to the alternatives and the capital required to produce it. Now let's open the machine. The fund uses a fund-of-fund approach tied to the iShares 20-plus-year Treasury Bond ETF, or TLT. Its benchmark is the Bloomberg U.S. Treasury 20-plus-year 12% premium covered call 2.0 index. The strategy writes 1 week at-the-money call options through covered call flex contracts and targets annualized option premium income of 12%. Start with the underlying bond exposure. That basket represents long-dated U.S. Treasury securities. Credit risk is not the main drama here. Interest rate risk is. Long maturity bonds can react strongly when the market changes its view of inflation, economic growth, government borrowing, or future monetary policy. Then comes the income overlay. A call option gives its buyer the right to benefit when the underlying asset rises above an agreed level. The fund stands on the other side of that contract as the seller. It receives a premium immediately in exchange for accepting an obligation if the bond exposure climbs. At the money means the option strike is positioned around the current market level when written. There is not much runway before the call begins limiting participation in gains. That tends to emphasize premium collection rather than preserving a wide band of uncapped upside. The 1-week expiration is equally important. This is not a call sold once and forgotten for a season. The strategy repeatedly returns to the options market, harvesting short slices of time value. Flex contracts allow terms to be customized rather than relying only on standard exchange-listed contracts. Imagine long-term bonds drift sideways. The calls can expire without capturing a major rally, and the fund can write fresh contracts. That is the environment where the machine's logic is easiest to see. Repeated premium collection from an asset that is moving but not escaping upward. Now imagine bonds jump because the rate outlook suddenly becomes much friendlier. The underlying exposure gains, but the outstanding calls transfer some of that upside to option buyers. From here, watch the relationship between monthly payments and the NAV path. If distributions remain steady while the asset base continues declining, determine whether option income is keeping pace or whether capital is doing too much of the funding. Next, compare performance during both bond sell-offs and bond rallies. Downside behavior shows how much cushion the premiums actually provide. Rally behavior reveals how expensive the upside cap becomes. A strategy should be judged across both halves of the cycle. Read the current distribution notices and tax reporting. Do not guess whether a payment was portfolio income, option-related gain, return of capital, or some combination. The label matters for taxes, and the pattern can offer clues about payout sustainability, but neither should be interpreted without the official documents. Monitor the option policy for changes. Strike selection, expiration schedule, premium targets, and contract structure influence how aggressively the fund trades future appreciation for current cash. A subtle change there can alter the investor experience even if the fund's name stays the same. Compare the fund against a plain long treasury alternative using total return, drawdowns, volatility, and actual cash needs. Then include personal taxes and reinvestment behavior. Two investors can own the same ETF and experience meaningfully different results because one spends the distributions while the other compounds them. Finally, pay attention to trading quality. Check spreads, liquidity, and the relationship between market price and NAV before placing an order. The portfolio may be built around government bonds, but investors still buy and sell shares through the market wrapper. This fund is not a miraculous treasury yield. It is a deliberate conversion machine. Volatile long-duration bond exposure goes in, recurring cash flow comes out, and part of the potential recovery is handed to option buyers as the price of admission. The early record shows that the machine can deliver a remarkably consistent paycheck. It also shows why income autopsy refuses to diagnose a fund from its payout alone. A smooth deposit can coexist with a bruised capital base, and the shareholder owns both outcomes. The right investor would need a specific reason to prefer immediate monthly cash over the cleaner upside profile of ordinary treasury exposure. The wrong investor is anyone treating the displayed yield as a guaranteed return or assuming government bonds make the entire structure low risk. Final diagnosis: credible income engineering, real interest rate exposure, and a trade-off that must be evaluated through total economic value rather than cash flow theater. Do not ask only, how much did it pay? Ask, after the payout, what did I still own and what opportunities did I sell to receive it? 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment: which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.